thinking over the next 10 years, where do I have the best chance of meeting my goals in terms of performance? Odds are it's not going to be the places that worked last year or the last 10 years.
A lot of people, after going through a year like 2019, where returns were exceptionally strong, need to sort of reposition their thinking as to what would they expect going forward, because you don't have a lot of consecutive years where you earn 31% in the S&P.
If you're trying to create a financial plan and you're thinking, well, I have this investment portfolio, what returns can I expect? And you just say, oh, well, I'll just get 2019 returns every year. Your financial plan is going to look excellent. You actually don't have to save any more money, and you can spend way more. So that sort of seems unrealistic. But anytime you're creating a financial plan, or you're trying to solve the problem of how much risk can I take in this investment portfolio, how much return can I expect over the long term, that's what you need expected returns for.
So looking historically, what is a traditional expected return investors typically target?
You typically hear somewhere between 6 to 8%, which is a reasonable return expectations from a diversified portfolio. 10 years ago, you want to get 6%, or well, actually more like 20 years ago, you could actually just invest it all in bonds. You could take almost no risk to get 6% because interest rates were so much higher and stocks were cheaper. Whereas now, you actually have to be very creative, because interest rates are so low, the expected return from the bond side of your portfolio is so low, and stock prices are so high.
Right, that's a great example. So let's talk about expected return relative to bonds. What's the expected return for the 10-year Treasury? How would you think about that if you were sitting here today looking for an investment?
If you're trying to predict over the next 10 years, you would take your current yield and you'd say, I would expect 1.55% return. And that works out very closely historically. So then you take this same type of approach where you're thinking, well, how do I predict returns over the next 10 years for stocks? And what's the primary driver? Just like a bond, your primary determinant of your future return in stocks is the price you pay today. If you're buying high to make money, you need to sell higher. You would much rather buy low and sell high. So what are the opportunities today to buy low? Not US growth stocks.
Okay.
That's for sure. So
tell us why.
You're buying very high. No matter how you cut it, you're buying high. We don't have high expected return assumptions for growth stocks. But the good news is, if you just move across the style box to value, the picture looks so much better. Value stocks over the long term, their trend is actually slightly higher. So a little over 8% trend return.
Okay.
And they're currently right in line with their trend. So you can get right around 8% expected return. And then you think of that 8%, over 3 is just from dividends, which are sort of your safest, most repeatable source of return. So I have that 5% I'm more uncertain about. So you feel much better.
And the 3 is double what you're getting in a 10-year Treasury.
Exactly.
Right?
Yeah.
So you're getting yield, you've got more potential for price appreciation. So that's US based or that's global? Tell us about like what outside the US is available.
Once you step outside of the US, generally stocks look cheaper. All foreign stocks are generally cheaper than US counterparts. They've been underperforming US stocks for quite some time. So that's a great first step, looking for opportunities to diversify into foreign stocks. But it's a similar phenomenon where if you buy foreign value stocks, you have a very solid expected return with higher dividend yields than you're getting in US value stocks. So those look good over the next 10 plus years. And then emerging markets also. They've been consistent underperformers, very negative sentiment. They look very cheap relative to their trend, relative to their earnings, and so on and so forth.